The latest U.S. inflation data showed prices cooled more than expected in February, giving the Federal Reserve room to keep interest rates unchanged at its policy meeting next week. The Consumer Price Index, released by the Labor Department on Wednesday, rose 0.2% last month, slightly below what economists polled by Reuters had forecast. That put the annual inflation rate through February at 2.8%, down from 3% in January. Sam Stovall is chief investment strategist at CFRA Research.
Looking at today's CPI report, I think investors are breathing a sigh of relief as it relates, first off, to the Consumer Price Index, since all four measures posted better than expected results. Stagflation is something that investors have been worried about, indicating that growth might slow, but inflation would stay sticky. This report, I think, goes a long way to ruling out the possibility of stagflation. However, recession is another matter.
Financial markets have been roiled by a cascade of tariffs imposed by President Donald Trump, and investors are increasingly concerned they could potentially trigger a recession. The relief offered by Wednesday's CPI report could be temporary, as the data did not capture Trump's tariffs, which has caused a surge in consumers' inflation expectations and prompted economists to upgrade their inflation forecasts. Goldman Sachs now estimates that another measure of inflation, the Core Personal Consumption Expenditures Price Index, closely looked at by the Fed, will tick up to around 3% by the end of the year.